There's a hole in your bank account. I am not talking about your spending or that coffee you buy every morning. I'm talking about a hole that is silently, invisibly, draining the value of your hard-earned money every single minute of every single day. And it's happening in the one place you were told your money was completely safe, your savings account. You see that balance? That number you've worked so hard to build? It's a bit of a lie, not in the sense that the dollars aren't there, but in what those dollars can actually buy is shrinking. You are saving money that is actively losing purchasing power. It feels like you're running on a financial treadmill and the bank just keeps turning up the speed. Today, we're going to break down the simple math most banks hope you'll ignore, and I'm going to show you how to patch that hole for good. This isn't just about saving more. It's about saving smarter. The reason your savings account could be a guaranteed loss comes down to two numbers: the interest rate your bank pays you and the real rate of inflation. Everything else is just noise. Your bank, the one with the big marble columns and friendly tellers, is probably paying you what the industry calls a competitive rate. As of this month, June 2026, the national average interest rate, or APY, for a traditional savings account is hovering at a meager 0.61%. Some of the biggest banks in the country are paying as low as 0.01%. Let's be generous for our example and say your account is earning 0.5%. Now for the second number, inflation. This is the rate at which the price of goods and services, groceries, gas, rent, goes up. The most recent Consumer Price Index, or CPI, showed a year-over-year increase of 4.2%. This brings us to one of the most important calculations in your financial life: the real return. It's your interest rate minus the inflation rate. Your bank gives you 0.5% APY. The cost of living is going up by 4.2%. So, 0.5% minus 4.2% equals negative 3.7%. Your real return is negative 3.7%. Let me say that again. By keeping your money in a safe savings account, you could be losing over 3% of your purchasing power every single year. What does that look like in real dollars? If you have $10,000 saved for a down payment or a rainy day, that $10,000 will only be able to buy about $9,630 worth of stuff next year. You lost $370 of real value, not because you spent it, but because you safely saved it. Over 10 years, that $10,000, even with a tiny bit of interest, would lose thousands in purchasing power. You did everything right, you saved diligently, and you still ended up with less buying power. This is the hidden tax on your future. Many people are terrified of the stock market's volatility. They see the numbers go up and down and decide, no way, they'll stick with cash because it feels safe. But the safety of cash can be an illusion. The real risk is the silent, guaranteed, day-by-day decline of its value. You're avoiding the possibility of a temporary drop in the market only to lock in a near-permanent loss from inflation. It's like being afraid of turbulence on a plane, so you decide to jump out with a leaky parachute instead. The danger you perceive is not always the real threat. So, how much is your savings account paying you right now? Go ahead and check. Drop the rate in the comments. Let's see how much damage is being done. The good news is you don't have to accept this. The drain stops the moment you decide it does. Getting ahead isn't about taking massive risks. It's about shifting from mindlessly hoarding cash to strategically deploying it. We need to move your money from places where it's melting to places where it can at least keep pace with, or better yet, beat inflation. The first alternative, and this is the easiest, most immediate action you can take, is the high-yield savings account, or HISA. Think of it as the online, supercharged cousin of your current savings account. Because online banks don't have the overhead of physical branches, they pass those savings on to you. As of June 2026, while traditional banks are offering under 1%, you can find HYSAs paying between 3.8% and 4.15% APY. Some even offer rates as high as 5%. These accounts are FDIC insured up to $250,000, meaning your principal is completely safe. By moving your money here, you immediately go from a negative real return to a neutral or even positive one. Second, for money you won't need for a specific period, say 6 months or a year, we have certificates of deposit, or CDs. With a CD, you agree to lock your money up for a fixed term in exchange for a guaranteed and typically higher interest rate. Right now, short-term CDs are offering yields between 4.0% and 4.15%. This is an excellent tool for money you've earmarked for a specific goal, like a wedding or a home renovation next year. The key advantage here is that you lock in the rate. With the future of interest rates always uncertain, a CD lets you capture a great yield before it's gone. Third, we have money market accounts. A money market account, or MMA, is like a hybrid between a checking and savings account, often coming with a debit card and check writing abilities, while offering rates much higher than traditional savings. They are currently yielding in the 3.5% to 3.9% range. These are great for a secondary tier of savings that you want to keep liquid, but still have working for you. Finally, the ultimate safe haven, US Treasury bills or T-bills. When you buy a T-bill, you are lending money directly to the US government. It is considered one of the safest investments on the planet. Current rates for short-term T-bills are in the 3.6% to 3.7% range. A huge bonus is that the interest you earn is exempt from state and local taxes, which makes the real return even higher. You can buy these directly from the government at Treasury Direct or through most standard brokerage accounts. These aren't complex, exotic financial instruments. They are basic, safe, and readily available tools that simply pay you what you're worth. Knowing the alternatives is one thing. Putting them into action is another. So here is a simple, 3-step plan you can start this weekend to overhaul your financial foundation. Step 1. The emergency buffer. This is your first line of defense. Keep about $1,000 to $2,000 in your regular checking account for immediate day-to-day emergencies. Then, take 3 to 6 months worth of your bare minimum living expenses and move it into a high-yield savings account, paying 3.8% or more. This is now the core of your emergency fund. It's safe, it's liquid, and it's finally earning a real return. Step 2. The idle cash lock. Look at your finances. Do you have extra cash sitting around that's more than your emergency fund? Any money you won't need for the next 6 to 18 months should not be just sitting there. Move it into a certificate of deposit or buy UST bills to lock in today's high rates. This protects that cash from future interest rate drops and forces it to pull its weight. Step 3. The growth engine. This is the step that helps you build real wealth. Once your emergency fund is secure and your short-term goals are funded, every dollar above that should be put to work. For most people, the simplest and most effective way to do this is through a low-cost total stock market index fund. You can open an account with a major brokerage, set up automatic, recurring contributions from your paycheck, and let the power of the market, which has historically returned an average of 8 to 10% annually over the long term, compound your wealth. The key here is consistency and patience. Set up the transfers and then stop checking it every day. Let the engine run. The safe savings account is a relic of a bygone financial era. In today's climate, it can be a wealth-destroying machine disguised as a responsible choice. It is a slow, steady drain on your financial future, and you are the only one who can stop it. For anyone wondering if there's a way out of working for the next 40 years, the answer is yes. The path isn't just about working harder. It's about making your money work smarter. It's about consciously shifting your assets from accounts that pay you almost nothing to alternatives that pay 3% or 4%, and eventually into the market where they can truly grow. The drain stops the moment you decide it does. This week, audit every dollar. Move what isn't pulling its weight. Stop the slow poison. Start making your money hustle as hard as you do.